Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillum, Chief Analyst at Wealth Within. This week I'll be talking about investing in exchange-traded funds, or ETFs as they're known, versus investing directly into individual stocks. I'll also cover the All Ordinaries Index and this week's stocks of interest that you, our viewers, have asked me to look at. Now, this week's topic is based on a question posted by ResMed, and I briefly answered this in last week's report, but I thought it warrants much more of an in-depth look, and so I thought I'd cover it more fully in this video. So if you have topics that you would like me to cover, let me know, or if you'd simply just like to ask a question like ResMed did, please be sure to put your question or subject in the comments section below this video. If you're a regular to this channel, welcome back, and if you're just joining us for the first time, let me extend a big welcome to you. Now, I'm sure you'll gain some great insights and some inspiration as to how you can confidently and profitably trade the stock market. And as always, if you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel to keep up to date. Also, before I get into the report, click the like button just below now. All done? Great. So let's get into this week's report. Prior to the global financial crisis, or GFC as it's known, there was a significant surge in the take-up of managed funds, largely due to the introduction of compulsory superannuation in 1992. However, given that many funds underperformed the market, or at best achieved returns of less than 8% per annum over any 10-year period, it was not too long before investors began questioning the value of these investments. Following the GFC is where the big reality check occurred, as many investors became even more disillusioned by the institutional funds, the returns they received, and how their investments were handled. The result was that people left these funds in droves as they decided that they could do better by themselves. Since then, we've seen a significant surge in exchange-traded funds, or ETFs as they're known, listing on stock exchanges around the world as a way for the financial services industry to attract money back into the market and back under their control. The rise in ETFs came about because investors were seeking greater transparency and control over their investments following the fallout from the GFC. They also wanted a simpler way to invest that allowed them to diversify their risk at a lower cost. But many investors have again started to question the value of investing in a managed fund through an ETF. So is investing in ETFs better than directly into individual stocks? Now, to answer that properly, let's take a look at what you need to consider when investing in each of these investments. An ETF is a listed managed fund that trades on the stock exchange just like individual stocks. ETFs provide investors with access to different asset classes such as stocks, commodities, bonds, debt, or currencies. Similar to an unlisted managed fund, an equity ETF, for example, can be exposed to up to 200 shares or more, which endeavours to replicate the performance of a specific index or benchmarks, such as the S&P ASX 200 index. Although depending on the asset class, ETFs may benchmark a currency such as the US dollar or a commodity such as gold. So in simple terms, they are pretty much the same thing as what investors were using prior to the GFC. Now, a major consideration for most investors when investing in the stock market is the associated costs of the investment. Consequently, one of the so-called benefits of investing in an ETF is that it provides investors with access to the market at a lower cost than many traditional managed funds. ETFs are also priced more efficiently to the value of the assets in the fund, as they typically operate with an arbitrage mechanism that assists in keeping the share price in line with the value of the underlying assets. Whilst these attributes make ETFs an attractive proposition, investors are still exposed to the same risks that led them to jump ship from managed funds during and after the GFC. That's because investors are still subjected to the fluctuations of the market, given that ETFs have to remain fully invested regardless of whether the market is rising or falling. And while some would argue that an investor can sell out of an ETF at any time, the unfortunate reality is that most don't sell assets that are falling in value for fear of losing. Remember, the goal of an ETF is to track an index or benchmark. But similar to the issue with unlisted managed funds, many investors are paying for the privilege of achieving average to below average returns. So let's look at an example. Looking at the screen right now, if we review the Vanguard Australian Shares Index ETF, or VAS as its stock ticker code, which is one of the largest ETFs in Australia, you will notice that it has underperformed the S&P 300 index, which is the benchmark for this fund since inception after management fees. And if you take a closer look at their disclosure, these returns do not reflect the transaction costs imposed on the creation and redemption of the ETF units, brokerage, or the bid-ask spread that investors pay to buy and sell ETF securities on the ASX. Okay, so what does that really mean? Quite simply, if these costs were factored in, the returns would be lower than what is actually presented. What is even more interesting is that the ETF receives dividends from holding the underlying securities in the fund, which forms part of their total return. Yet the index which they are benchmarking themselves against does not include distributions from dividends. If it did, then the performance of the benchmark would be considerably higher. The reality is that many investors are happy to turn over their savings to professionals in the hope of achieving better returns than they could on their own. But as this example demonstrates, this is not always the case. So, are you better off investing in individual stocks or ETFs? For those of you who follow my philosophy, you will know that I favour investing in individual stocks, but only if you're prepared to gain at least some knowledge to protect your investments. That's because the number one reason why the majority of investors fail in the stock market is due to a lack of knowledge about how the market works and how to manage risk. According to the financial services industry, one of the major benefits of investing in an ETF is that you can achieve greater diversification than if you invested directly yourself. But as I've previously demonstrated many times, this results in a fund holding up to 100 different stocks or more, which not only increases the risk of the portfolio, but dilutes investment returns, condemning you to investing mediocrity. Think about it, you don't get twice the benefit from holding 20 stocks than you do from holding 10, and you certainly don't get 10 times the benefit from holding 100 stocks rather than 10. Given this, it seems unrealistic to justify why fund managers would continue holding so many stocks when the diversification is so small. Unfortunately, the myth surrounding diversification, or what I like to call diversification, is one of the main reasons why investors have to accept lower returns. Because whilst it's true that diversification reduces risk, a portfolio of shares that is over-diversified is exposed almost exclusively to market risk, which cannot be eliminated by diversification. That's a really important point. The truth of the matter is that a well-diversified portfolio that allows you to achieve maximum diversification and minimum risk only requires between 5 and 12 stocks in a portfolio. For those of you who read my latest book, Accelerate Your Wealth, It's Your Money, Your Choice, you know that I outline in the book why this strategy achieves far better returns and does so at lower risk. In fact, in the book, I trade a portfolio of the top 20 stocks in the ASX over a 10-year period from the 2nd of January 2007 to take into account the effect of the GFC through to the 31st of December 2016. And I do this using some very simple trading techniques such as a trend line and a stop loss. Now, some of you may be surprised to learn that the gain achieved from capital growth and dividends was 225.82%, or an average annual return of 22.58% over the 10-year period. Remember, that includes the large fall in the GFC. Now, this return equates to an annual compounded rate of return of 12.54%, which I'm sure you'll agree is much better than having your money in a fund. So the view that investing directly in the share market is complex and mysterious and best left to those profoundly wise and experienced mortals who know what they're doing is a fallacy perpetuated in part by those in the industry who stand to gain from your anxiety and ignorance. Indeed, investors are increasingly questioning the conventional wisdom of over-diversification and are now finding the enormous benefit of investing in a concentrated portfolio like I show people how to do in my latest book. Now, the reality is that most investors just want to achieve a good, safe return on their investment and a no-holds-barred approach to doing so. Quite simply, this is why many are taking a more active role in their own wealth creation strategies and investing directly. So my advice is that you should take the time to investigate if direct investing is far better for you. Indeed, the choices and benefits of investing directly in individual stocks that are available to the small investor far outweigh the lower returns offered by ETFs and managed funds, which is why I strongly encourage you to read my book, as it will change how you view the market. And more importantly, it will give you the knowledge and tools to change your investments so you get more returns. Now let's get into this week's stocks.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
Alrighty, it's been an exciting week on the market in the last week, and it's also been an exciting week on our YouTube channel. We've got I've had a lot of questions, as you can see there, a lot of different people asking me questions, asking me for stocks, those sorts of stuff. I just thought I'd cover a couple of them first, but we've got about 5 or 6 stocks to go through from you. So if you do have a stock that you want me to analyze, you do need to go down below and type it in. But I really do like you to put in, why if you own it, if you don't own it, if you're looking at buying it, why you're looking at buying it. Because this is about understanding and learning a little bit more about how the market works and how you can do better by not putting those sorts of things in. You're actually only doing yourself a bit of a disservice. It's about helping you. Part of the reason why you're coming to this channel is so you can learn more and help you get more profits from the marketplace. So I need to know a little bit more about you before I can help you. But just to get into, I'll just put my glasses on, just to get into a couple of the things here first. Aussie Fide said subscribe and like. So welcome to the channel, Aussie Fide. Hope you love the channel and you stay with us and post us some questions and get a lot out of being on the channel. Steve Pappas, he said, hi Dale, received the book. I'm assuming he's talking about Accelerate Wealth, my latest book, and very much appreciated and very informative video, Stephen. He also said, hi Dale, on a second post. I'm about 30% of the way through and we'll read it twice. Much appreciated your offer of asking questions. Your videos are made to the point, and therefore was very happy to buy the book. I'd like to put finance and travel stocks on my watch list for 2019. When people say to me, I want to put this sector or that sector into my watch list, to me, it's not about sector investing. It's about buying stocks that go up and stocks that go and get out of stocks that are going down. It's not about sectors. I know a lot of people talk about sector weighting and adjusting sectors, those sorts of things. I don't do it. Buffett doesn't do it. You shouldn't do it. Simple as that. But finance, as you've seen in my videos over the last few weeks or last couple of months, the finance sector is one of those ones where I was saying way too early. Today, we're hearing all the news from that Royal Commission report, and I don't expect banks and other financing stocks to do very, very well over the coming months, maybe in the second part of this year, maybe towards the middle part of this year. Travel stocks a little bit differently, but again, it's which one do you pick? It's more about stock specific rather than a sector itself. So just sit back, Steve, and wait a little bit, and if stocks proves it's good, I find that if you focus on one sector, you miss stocks in other sectors as well, because you're looking at another place rather than just looking for stocks to go up. And that's really all you need to do is forget about what the industry says and sector weight and divide your money across multiple sectors. Doesn't work. It's good for them. It's not good for you as an individual trader. So another one, Ian S. He said, hi Dale, bought your book. What's amazing is I actually read it from start to finish and couldn't put parts of it down. I have 3 other stock trading related books, all of which have been started and never completed. And I'm taking your advice and have started rereading from the start again to ensure I completely understand. Wish I'd read it all before spending a fair bit of money on video training via someone else that is too complex for me to remember, let alone execute. Once I have some trading under my belt, I hope to join the Trading Mentor course. Thank you. Really common comment that Ian's given us here. I find a lot of people have come back and said, hey, wow, your book's the first one I've ever read from cover to cover. I couldn't put it down. it kills all the other trading books that I've got. Because when you're talking about people writing trading books, often they can't explain themselves, and therefore they get too technical or they go off track all over the place. And I had that experience, many years ago when I first started trading 25 odd years ago, and just trying to find a good book was really, really hard. That's why I brought mine down to really basics, ABCs, and showing you what to do, how to do it, and why you're doing it. A lot of books just show you some techniques, but they don't really give you an education, and that's really what Ian's actually found in that. And then he went and made the fatal mistake and went onto the web and bought some video training from somebody probably not very well known, or that sort of thing. And we find that's the case a lot. We get comments from people every single week coming to us that have tried YouTube videos, who have tried online courses, bought courses from overseas, online video series, all sorts of different things like that. And the people behind them, you don't really know much about them. With us, we're an RTO. We're accredited by the Australian government. We're an accredited educator. We've got accredited courses. We're ASIC licensed. We're a fund manager. So you know exactly who we are, what we do, how we do it. And so you're going to get quality education with us. So looking forward to mentoring you, Ian, when you get to the Trading Mentor course. So that's those. Now let's get into the market, and then I'll look at all the stocks. I'll just put my sheets down here and we'll go into the market. On your screen right now, you're seeing the All Ordinaries Index, the weekly chart of the All Ordinaries Index. And you can see here, if I just scroll that up a little bit tighter or a bit bigger there, you can see that last week our market closed lower than open. It's an inside bar. Now, this means stuff to me as a trader, being an inside bar. We teach all this in our Trading Mentor course, how to understand bars, what that actually means, and what it means in terms of the psychology of the market. So it opened at 5971, closed at 5935. So about a 50-point range. It closed near its low, which I'm suggesting, like I was last week, that we should see 1 or 2 weeks down. That's 1 week down, but it's not really a down bar. It was an inside bar. It didn't make a lower low. Where my pointer is right now is the previous week's low. Therefore, it didn't get lower than that. So I'm expecting a red bar this week, to come through on our marketplace. Probably the banks will be driving that with the Royal Commission report out today. The finance sector will probably drive that out today. So I expect our market to come down. Nothing to worry about, just normal stuff on the marketplace. And one day doesn't make a sheep station, neither does a week. So to me, I think we're going to get 1 week down, maybe 2. Now, if I put one of my little tools on here, and I'll just click on here to here. Basically, what I'd be looking at, staying above that 5788, and if I go and put another level on it, and what I talked about in my weekly report that I send to journalists, and the meeting gets published in newspapers. I do that on Friday. I said it'll probably be around about 5,800, above 5,900. It'll probably come down. I'll touch its head on that. My thinking is, if the market is really bullish, it should come down to around that level. So we might have a bit of a dip. Hopefully it stays above that level. We may get 2 more weeks down to that level. We may get it all the way down to 5788, but I don't expect it will. I think this 5854 will hold it up and we'll start to take off again from there. But right now, sit back. You don't need to take any new trades over this week, just unless the stock is really strong and gives you that signal. But right now, it is looking good on our marketplace for the rest of the year. Did a little bit of research for the media only for last week and talking about January, because there's an old saying, a wives' tale saying, if January's good, the rest of the year's good. BS. It's about 50-50, and looking back over the last 10 years, it's about 50% of the ones that went up, and January's went up and down. It didn't make much of a difference to the actual end goal for the year. So we had down Januaries and up for the year. We had up Januaries and down for the year. So really about 50-50. You've got to be careful about listening to some of those old wives' tales and listening to that noise in the marketplace. Look at the stocks, look at what they're doing, buy them. You don't buy the market itself. So let's go and look at some of the stocks. Now, I'll just bring up those stocks here, wherever they are. I've got them here somewhere. There we go. Here's all the Australian stocks. The first one I want to look at is, I believe, AFI, and I'm just going to try and find out who gave that to me. It was Deb Wallace. So thanks, Deb, for sending me in stock for me to review. So Deb said, what's your opinion on AFI? Although I don't hold any shares, I noticed this stock in mid-December as it was still dropping. I did put it on my watch list for some reason. What are your thoughts, Deb? Having a look at AFI, if I bring up the weekly chart just so you can have a look at it, if I put my pointer on there, you can see here at the end of December it was dropping. So the point that Deb's talking about, mid-December it was still dropping. So put it on the watch list and have a look at that phenomenal rise since then. So I don't know whether Deb's actually purchased this or not. Quite a volatile stock, but if we put our let me go and put my tool on here. Where is it? Where are you? No. There it is. If you look at that, we've seen a big move up closing last week. It was up nearly, just over 9% on the past 1, 2, 3, 4, 5 weeks. Really, really nice looking stock. It's got a bit of resistance around where it is. I think we might see a day or two down here. Normally, I don't buy stocks like this. This is basically a managed fund that's listed, so to speak, if that makes sense. Australian Foundation Investments. They're investing in the stock market, and obviously they're a company doing that, and that's how their returns are. You generally don't necessarily outperform the market too much in these sorts of stocks, and you can see here how way back here in 2015 it hit a high of 645. Here it hit a high of 644. That's a double top in anyone's book, but it hasn't had a huge fall. But if I go back a little bit further, you can start seeing here that you could have owned this stock way back here in 2013 at a high of 633. So anybody holding that stock over that period of time for the last 5-6 years, you wouldn't have made any money other than some dividends coming through. So it's one of those stocks. If we keep going back a little bit further, you get some growth here, but look at that. If we go back to 2008, and again, you see a high around here. So it's one of those stocks that you would trade. You don't buy and hold this sort of stuff. And you can see this huge, big sideways movement. So until I got through this 640, 650 level up around here, I wouldn't own this stock. It's highly likely that it'll turn around and come back down again. It may not. It may blow through it, but I'd sit back and wait for that one. So thanks, Deb, for that one. What's the next one we've got here is AVZ. Now this was, here we go. It's somebody called OX, and he said, hey, can you look at 2 stocks for me, LYC or Lynas, day trading lows to highs, 4C-300K shares at 16 cents, 30 kilometres from AVZ, highest quality lithium found, drilled shallow, good results, and looking to drill deeper. I feel it's one hole away from 3 cents, which is a good trade, but I also feel I've been in it for too long now, AVZ. AVZ is the other stock. So Lynas and AVZ. I came back and said, look, can you be more specific with your questions? It really does help me to be a little bit more specific. I understand your day trading, Lynas. Can you explain how you're doing that? What are your rules, etc.? What are you using? You mentioned the other stock. I'm not sure what you mean. I understand what you'd like me to look at AVZ. But I didn't really understand why he thought it would move from 5 cents, which was his current trade, down to 3 cents. Are you looking at shorting? So I'm going to have a look at those stocks right now. And nothing to do with this person. I don't even know your name, but a lot of times I'll ask somebody what are their trading rules, whether it's on the phone or whether it's on Facebook or YouTube or some sort of little forum like this. What are you doing? Why are you doing it? And most of the time they don't come back with anything. And that tells me that they don't really have solid trading rules and that they're guessing or they're buying and hope. And pretty much everything that this person said about what's going on, drilled shallow, showed good results, looking to drill deeper, feel it's a hole away from a good trade. Well, that's all speculation and everything to me. It's not fact. And when I'm teaching traders, you trade on confirmation, not speculation. What might happen, what they might do, what profits they might have, what holes they might do. Things can happen. Mines can collapse. Dams bust, as we saw last week with Vale, which shot FMG and Rio up through the roof in prices. Things happen all the time, but the charts actually tell you what's going on. So all of that speculation and nothing I would ever trade on. And as I said, I'm not trying to be rude to anybody, but having good solid rules really does help you trade. So let's look at AVZ and then we'll look at Lynas. Lynas Corporation. AVZ Minerals, looking at that, you've got a monthly bar chart on the left, weekly bar chart on the right, and both charts look crap. Just to be honest with you, they look terrible. It's a very, very volatile stock, and And as you can see here, if you look at this, we're talking about over since April 2017, it shot up 1,800%, but then you've lost nearly all of that if you're in the stock. Now, I don't know whether you're in that stock or not. I know you mentioned you're in one stock, but, holding stocks like this as they're falling through the floor is just not good trading. And it just looks like it's going to continue to fall south. If I open up the weekly chart, all too often people speculate on these very, very low cap stocks and these very small stocks because they go, well, it's only 5 cents or 10 cents. And it's only got to move 1 cent and I make 10% or 50% or 100% if it does go 1 cent. But the chances of anybody without a high level of education getting these right consistently is pretty much zero. You've got less than a 0.1% chance to really capture some good profits out of these. And if you do, it's luck, not necessarily good management or good trading skills. I wouldn't trade a stock like this with all my knowledge, and I'm not trying to be rude to anybody. All I'm saying is you need to have solid rules and trade better stocks because you're going to... Trading is about getting consistency in terms of win-loss ratio and profit loss. How many wins to how many losses, how much profit do you make every time you win, how much loss do you have every time you lose. It's all about money management. It's all about risk. And you really do need to understand that. It's not necessarily about going for these speculative stocks. You make far more money when you get a good stock that's quite consistent and you've got a good strategy on it. You just keep compounding your returns and you'll get less heartache. It sounds to me like you've been holding a stock way too long. Possibly, you're probably losing money on one stock, and I only had a big example of that only a few weeks ago from somebody else. So right now, I wouldn't own this stock, and I'll go down to a daily chart, and you can see how speculative this stock is. It's not looking healthy right at this point in time. So let's quickly look at Lynas. Much better stock, bigger stock, much more liquid stock, still quite volatile. Looking at that monthly chart, you can see here how it keeps having lows right down around that 70 or 80 cents. Now it's trading at around $1.70. It's had a nice, beautiful uptrend through from 2014. And it's looking a lot better actually. I don't mind this stock, but it has been a little bit more bearish since this high here in May 2018. So it's been going down. It should be finding some support pretty much soon, but right now it's looking a little bit better. As you can see here, we've had that low here right there. With my pointer on the weekly chart now, $1.48 in January of this year. It's had 1 week up, couple of weeks down. So far it's made a higher trough there at $1.52. For this thing to get me really excited, it would need to trade above that high there. Firstly, at $1.77 before I'd even get excited about it. But really, until it gets sort of through that $2 area there, I'd really seriously be questioning it at this point in time. But I'm not suggesting it won't go, but it's a much better pick from your point of view. Talking about day trading it, I'm not sure what you're doing, how you're doing it, picking highs to lows, because that's really not a solid strategy for trading and making good money. All too often people jump into a stock in the morning and try and get out by the afternoon, and you make tiny little bits of money. The amount of work people put into that for the effort and the return that they get, it's really not worth it in terms of time and effort. You're better pulling back from the market, having some solid rules, and going to do other things rather than trying to watch a trade during the day. You'll make far more money and you'll put a lot less effort into it. But nice looking stock at this point in time. The next one we're going to be looking at is Origin. I'll just see who's asked me about Origin. Here we go. Not Aussie Fide. Steve, I've done that one. AFI Deb. Here we go. Gregory Asmanis. Hopefully I said that correctly, Greg. Welcome to the channel. Thanks for recommending this stock for me. He said, Dale, any opinions on Origin? Okay, I've got some opinions on Origin for you. Origin, great stock. Energy stocks tend to be really, really good because they're quite consistent in their cash flows. That said, this stock, as you can see, has been quite bearish from that high there it had way back in 2008. It hit right down to that low in 2016 down at that $3.44. But since then it's been moving up nicely in a nice little trend, and it looks like it's found some support and is starting to move up again. Now we can see that on that weekly chart over the right. We'll have a quick look at it in a second, but I'm not putting a lot of tools and analysis on this. I'm just running things off the top of my head, because by the time I put tools and everything, it makes the video too long when I put a whole lot of stuff on the charts. But this is looking quite nice. So if I put my price retracement tool onto this, and whack it over there. You'll see here it's found that support at 61.8%, that Fibonacci number. Now, I find some people tell me, well, it's not on the right low there. Just whack it over to there. Yeah, so it's found support right there. To me, this is looking all right, although last week is a little bit bearish, but I think we might see it slow down a little bit. Might have one more week down and then take off. So stick this one on your watch list. It's looking all right. Next stock is Paragon Care. Now, we've got Paragon Care. We've had, where is it? Here we go. Howard T. So thanks, Howard, for being on the channel and giving us a stock. Hi, Dale. Thank you very much for your video. It's very informative. Can you please cover Paragon Care PGC? I do not own it and am thinking of buying it. What have I said there? Thanks very much for your reply. I want to... sorry, Howard. I've replied to Howard and he come back again. He said, thanks very much for your reply. I want to invest in some healthcare-related shares. Great, because I think healthcare is a good sector this year. PG seems to make profit over the last few years, despite profit margin is dropping slightly. As shown in their financial report, PGC bought many new companies in 2018 with bank loans. I believe there is a chance as they will increase their profit significantly in 2019, and I want to get it before the price gets up. P.S. I bought your new book, Accelerate Your Wealth. I bought your new book, Accelerate Your Wealth. The book is fantastic and very informative. Thanks very much, Howard, for saying all of that. That's really appreciative of that. I understand what you're saying, but at the end of the day, people buy stocks, and I don't mind losing some off the bottom to get a stock going up. And too many people try and bottom pick stocks. So looking at Paragon, it has been going down a little bit, and see, it's quite choppy. It's quite a little bit more of an illiquid stock. You're better on some of those bigger stocks. But let's have a look at this. Right now, it's in a downtrend. That's really what I can say for you. It's a little bit too early to suggest that it's finished falling. It is very much in a downtrend. If I go and shove on my trend line tool, you'll see here that if I whack it on here, you can see the angle of that movement down. If it's doesn't break through this over the coming couple of weeks, it would suggest it was going to keep falling further, and it may fall sort of down to this sort of level here at around 51 cents. I think there's better stocks at the moment on the market for you to have a look at, not so much Paragon. Right now, you know all that stuff that you've just mentioned in your comments to me. The whole market knows that, and they're still not buying it at this point in time. You want that momentum behind you. You like the train of a lot of people, full of people buying the stock behind you. Right now, they're not doing that. So just be a bit careful at the moment. I'm not suggesting it won't go up this year. I'm just suggesting right now, it's just sit and wait for this point in time. The next one is ResMed. That was by, who's that one's by? ResMed. It's Frank. Frank suggested, he said, hi Dale, what do you think of ResMed? Was trending up nicely until they released the quarterly reply. I said, hi Frank, welcome to Wealth Within TV. I'm not sure what you're talking about, as ResMed just made its latest all-time highest price only 2 days ago. That means it's trending up nicely. Given Monday's a holiday, I've just recorded my stocks and I didn't get to do it last week, so I'm doing it this week for you, Frank. So thanks very much for putting ResMed on the list. And Frank said quarterly report was released today. That was the Friday, so that's Friday week ago. So you may not have seen it yet. And I went, that's fine, Frank. It still doesn't change my comment because one day doesn't make a trend. And I really want to comment on that. Too many people look at the market in a microcosm. One day is irrelevant. And Charles Dow, who's the founder of the Dow Jones, said daily fluctuations are irrelevant. And they really, really are. Too many people jump on and off stocks because of what happens in one day. Please don't do that. Right now, you can see this is a weekly chart, and the week that Frank was talking about is this week. And yeah, big down week here. So we're talking about a week where the range was $2.15 on a $16.50 stock. So it's a big hit. Then it gapped right down last week on the Monday here down to $12.81 and traded up again. Stocks, this will fill that gap. I'm pretty confident. Good stocks like ResMed. ResMed made its all-time high on this week. So we're talking about this is not a trend. Please do not expect that 1 or 2 weeks is the trend. It does not do that, or it doesn't work that way. And too many people look at the market in a microcosm of 1 or 2 few days rather than the bigger picture. We can see over here, this move down here in April 2015. There's 1, 2, 3, 4 weeks down, and then it took off like a rocket. I'd stick ResMed on my watch list and stick it there because I think we're going to fill that gap and it might start to move up again. So that's my thoughts, Frank, on ResMed. Right now, I'm not too worried about it. All stocks they rise to highs and then they come down to trough, and then they rise to another high and they come down to the trough. People watching news and media will get it wrong most of the time because news and media is about getting you to watch news and media. So they sensationalize things, and the market or the big end of town look at stocks and look at the announcements and push prices around to get people to trade. So they may have known that ResMed was going to come out with the result that they did, so they go in and start selling the stock to get everybody else to start selling it and cause a whole lot of transactions happening, and then they start buying it back at a lower price so they can make more money. Remember, the industry is not there to help you make money. That's your job, and you need to know what you're doing. The broking industry makes money by you trading. The financial services industry makes money by you doing things with them. I'm suggesting if you've got nice rules and structure around things, that you'll do all the profiting and you'll be giving them less money and fees, and you make more money in your back pocket, and that's really got to be good. So that's it for me for this week from the stocks. Remember, hit the like button now. Subscribe to our channel. You do need to do that. That really does help us. Hit the like button now. If you've got questions, please send them through. Love to answer your questions. If you've got stocks for me to review, please do that. Really happy to do that. One last thing before we go, we are going to be starting live streaming in a couple of weeks. We're going to do some beta testing in the next couple of weeks for live streaming, where I'm going to be taking live questions, etc., from you and talking with you live. So watch out for that. Good luck, good trading. What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on Soundcloud and on our website. Now, they're jam-packed with valuable information which will help you elevate your trading. Now, if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.